In today's The Market Report, we'll discuss if Bitcoin's latest bounce at $25,000 signals strength or a potential alert for further correction. What are the indicators telling us? Plus, I'll explain why miners estimating a $100,000 target based on the spot ETF approval doesn't mean that much. Hello everyone, welcome and thanks for watching The Market Report. I'm your host Marcel Pechman, analyst and writer at Cointelegraph. This show debates the most pressing topics impacting the crypto market, focused on price changes and meaningful events. Today's show is sponsored by XGO. Our first article was written by Nivish. Bitcoin price dips below $25,000. Opportunity or sign of incoming disaster. Bitcoin stands at the edge of a bearish breakdown with a small possibility that a $25,000 support level could hold. According to trader The Flow Horse, Bitcoin at $25,000 presents a short-term buying opportunity as it's the best area to trap sellers. So here you have the tweet from The Flow Horse. I feel like the chances that the market smoked this level after the first major test is slim. Seems like the best area to trap sellers and argue the best place for long contextual R2R, meaning risk-adjusted return. I'll catch a falling knife. So he's making a joke about himself because typically it's a really risky trade. What he's saying is that the first time it got defended, $25,000, so the odds are will likely defend it again, and the target area would be near $31,000. The article goes on to explain that the dollar strength index DXY, which measures the US dollar against a basket of foreign currencies, has apparently tapped out after reaching 105. So here you have the chart of the DXY index, which measures the dollar against a basket of foreign currencies. So whenever it moves up, like it did from mid-July to the present date, so moving from 99 up to 105, it means that the US dollar is actually gaining strength. And this is what happened over the past 7 weeks. But as you can see here on the latest red candle, the movement could be potentially fading away. Some investors believe that whenever the market is seeking shelter in US dollar and US treasuries, it means that there's likely lower demand for Bitcoin and cryptocurrencies. So yes, in the past there has been some inverse correlation between Bitcoin and the DXY, the dollar strength index, meaning that Bitcoin's price tended to decline whenever the DXY index improved. But to be more precise, that correlation only held valid for 40% of the time over the last 20 months. So it's not really a strong correlation. Thus, regardless of a valid rationale for the correlation existing, in practice, the indicator is not reliable given that multiple factors influence Bitcoin's price performance, apart from the demand of US dollars as a safe haven. The article now shifts its attention to a Glassnode analytics report. According to the latest report by on-chain analytics outlet Glassnode, Bitcoin's price drop over the last few weeks has caused several metrics to tap historical lows. The current market conditions are characterized by low liquidity and low trading volumes. Okay, first of all, what are the meaning about low liquidity? It means that there are fewer buy and sell orders on exchanges, at least in comparison to historical levels. This could have been caused by market makers being unable to time the market and are now unwilling to add positions, or simply because investors have no interest in trading at current price levels. There's no way to know what drives each market participant. But by analyzing the volumes traded, one can infer whether the drop in liquidity reflects lower activity. In this case, CoinGlass report also notes less trading activity. According to the CoinGlass report, the total USD volume of coins changing hands using our entity adjustment clustering is nearing cycle lows of $2.44 billion a day, has returned to October 2020 levels. Now, back to the Cointelegraph's article. Glassnode also noted that volatility, liquidity, trade volumes, and on-chain settlement volumes are at historical lows, which has pushed the market into extreme apathy and exhaustion. I think the biggest highlight is the use of the word apathy, meaning there's literally no interest from buyers and sellers at 25,500. It makes sense given that we've spent the last 25 days near such a level. But CoinGlass also adds the exhaustion description, which indicates that both sides, longs, the buyers, and shorts, the sellers, are now comfortable with the $25,500 to $26,000 level as being the fair price for the moment. Personally, I don't agree that bouncing at $25,000 represents an opportunity for buyers, given that the short-term risk-reward near the current level sounds like 50-50. It can flip either way. Bulls got tired after the relentless action by the SEC to pursue Coinbase and Binance. Meanwhile, bears are unwilling to add risk given that BlackRock has a stellar track record on approving ETF requests. Just to highlight, that's my own personal opinion and does not constitute investment advice or reflect Cointelegraph's official view. Now onto the show's next topic, an article written by Garrett. Bitcoin to hit $100,000 in 2024, Canaan VP waits up 2024 halving opportunities. Canaan Vice President Davis Hu believes supply deficit following the next Bitcoin halving will drive its price past $100,000. Hu told Cointelegraph. What about BlackRock? They're holding on to $10 trillion of assets under management. The overall crypto market cap is $2 trillion. They have 5 times more than that. Well, I don't know when he said that. I think it was a week ago, but the cryptocurrency total market cap is $1 trillion. Maybe he explained that during the peak of the bull run, the crypto market was $2 trillion. Either way, he's saying that the BlackRock's AUM is vastly superior versus the crypto market capitalization. Okay, let's go back to the drawing board here for a moment. What is BlackRock? So yes, it's the world's largest asset manager with $10 trillion of assets under management. But they only have a say in the allocation of $6 trillion, given that the remaining assets are either ETF funds, so they can only invest in what was promised, like gold ETF or S&P 500 ETF or MSCI Global Stock Market ETF and whatever. They have no decision on where to invest those. The remaining are also separate managed accounts or private equity. And again, BlackRock management doesn't have a say on where to invest those. Moreover, their allocation in exclusively fixed income investments stands at 37% of the total, which is kind of typical for the industry. So, realistically, even if they decided to invest 30% of what is not allocated in fixed income, that would leave roughly $1 trillion to buy Bitcoin, not 10. But we all know that will never happen, and the most optimistic assumptions are a 1% allocation, which amounts to $35 billion. Sure, there's always the possibility that BlackRock's get additional inflow for investors deliberately willing to buy the recently launched Bitcoin ETF. So there's nothing stopping the Bitcoin ETF fund to reach $50 billion. Now back to comments from the Canaan ASIC miner VP. This money will come in. The Bitcoin demand will increase while the supply has decreased and the price will increase. He might be right. I mean, the supply side will be affected by fewer coins being mined every day. But we can't infer on the demand, let alone what would happen to the investors that have been holding all the way down from $65,000, $55,000 and $40,000. They might decide to deposit those coins on exchange and dump as the Bitcoin price increases. So we cannot predict neither the buy side, the demand, nor the offer side. But more importantly, miners have no way to infer on the Bitcoin price and are mostly forced to sell their production to cover expenses. And even if they gamble by postponing or anticipating sales, that has nothing to do with miners' profitability. Those are two completely different business. A, trying to predict the price and betting on it. B, mining, which basically involves finding efficient energy sources. Now, do I agree with Canaan VP on the ETF being the main driver for price increase apart from the halving in 2024? Yes and no. Sure, it will catapult the price after its launch and gathers at least $10 billion in assets under management. But the first request for a Bitcoin ETF came from the Gemini brothers, Winklevoss, in over 8 years ago. And the SEC main refusal point remains Tether, so stablecoins, and offshore exchange. Nothing changed, so I remain skeptical about the ETF approval odds in 2024. Well, that's it for today. Hope you guys enjoyed the show. Don't forget to visit Markets Pro, the professional Cointelegraph alerts platform. Our proprietary indicators have been giving profitable alerts for months. There's a 20% discount link in the video's description. Don't miss it. See you!